Every year, the world produces about 90 trillion financial transactions. Every one of them has to be recorded, categorized, checked, and eventually turned into a number a government, a bank, or a shareholder can trust. For 6,000 years, that job has belonged to one profession. Clay tablets in ancient Mesopotamia recorded grain and livestock. Double-entry bookkeeping, invented in 14th century Venice, gave merchants a way to prove their ledgers balanced. And for the last century, accountants have been the quiet infrastructure of every company on earth. The people who make sure the numbers are real. Today, a new kind of ledger keeper has entered the profession. It doesn't sleep, doesn't take vacation, and can read a company's entire financial history in the time it takes a human to open a spreadsheet. This is the story of what happens when artificial intelligence meets the oldest paperwork job in the world, and why the accountants who survive it may end up doing something almost unrecognizable from the job that exists today. To understand what's changing, you first have to understand what an accountant actually does, because it's far more than data entry. A working accountant spends their day reconciling bank statements, categorizing expenses, preparing financial statements, filing tax returns, and translating a business's raw activity into numbers regulators and investors can act on. A large share of that work is repetitive by design. The same categories, the same forms, the same seasonal deadlines, year after year. That repetition is exactly what made the profession stable for so long. It's also exactly the kind of task that machine learning was built to eat. Pattern recognition, classification, matching one document against another. This is the same category of problem AI has already solved in image recognition and language translation. The difference is that accounting has a much lower tolerance for error. A blurry photo mislabeled by an algorithm is a minor annoyance. A tax filing mislabeled by an algorithm can trigger a government audit. That tension, a task that's mechanically easy for AI but consequentially expensive when wrong, is the real story of this profession's transformation. The first wave already happened, and most people never noticed it. 2 decades ago, small business bookkeeping meant a person manually typing every transaction into a paper ledger or an early spreadsheet. Cloud accounting software changed that quietly, one feature at a time. Bank feeds now pull transactions automatically. Machine learning models watch how a business has categorized expenses in the past and start suggesting, then eventually auto-applying, the same categories to new ones. A payment to a shipping company gets tagged as freight without a human touching it. A recurring software subscription gets flagged and matched to last month's entry automatically. None of this looked like an AI revolution from the outside. It looked like software getting slightly more convenient every year. But the cumulative effect was enormous. The entry-level task that used to occupy junior bookkeepers for hours every week now happens in the background, silently, for millions of businesses, before anyone opens their laptop in the morning. The next frontier was the paperwork itself. And this is where AI stopped assisting and started replacing. Optical character recognition used to mean scanning a receipt and hoping the software could read the total. Modern AI document processing does something categorically different. It reads an invoice the way a person would, understanding that net 30 is a payment term, that a handwritten total in the corner overrides a printed subtotal, that a vendor's tax ID appears in a different place on every single invoice format on Earth, and it extracts the right numbers anyway. Large accounting firms now process tens of thousands of invoices a month through these systems, with a human reviewing only the exceptions the AI flags as uncertain. What used to require a team of data entry clerks working full-time now requires one person checking a dashboard of edge cases for an hour. The job didn't disappear all at once. It compressed. The same output produced by a fraction of the people at a fraction of the cost. Tax preparation is where this shift becomes visible to ordinary people, not just accounting firms. AI-assisted tax software can now interview a taxpayer in plain language, Cross-reference their answers against thousands of pages of tax code, flag deductions a human might miss, and file a return, all without a licensed preparer ever looking at the file. For a simple return, this is already faster and, in many cases, more accurate than a human working from memory of last year's rules. But taxation isn't one simple problem. It's thousands of overlapping jurisdictions, each with its own exceptions, phase-outs, and edge cases that change every single year. A freelancer with income in 3 states, a small business claiming a research credit, a family navigating an inheritance. These cases sit exactly at the boundary of what current AI systems handle well. The technology has absorbed the simple 60% of tax work almost completely. The complicated 40% is where human judgment and human liability still matters enormously. Auditing may be the most striking transformation of all because it flips the entire logic of the job. A traditional audit works by sampling. An auditor examines a representative slice of a company's transactions, maybe 2 or 3% of them, and extrapolates whether the rest are probably clean. It was a compromise built entirely around the limits of human time. AI removes that limit. An anomaly detection model can now examine 100% of a company's transactions, not a sample, looking for patterns that don't match the rest of the dataset. A vendor paid on an unusual schedule, an expense category that spiked without explanation, 2 invoices that are suspiciously identical. This doesn't eliminate the auditor. It changes what they audit. Instead of hunting for problems across thousands of routine transactions, the human auditor now spends their time investigating the small number of genuine anomalies the AI has already isolated. A shift from searching for a needle in a haystack to simply being handed the needle. The corporate world has already run this experiment at scale, and the results are worth sitting with. One well-documented case. A European fintech company automated a large share of its customer-facing financial operations using AI, and reported that the equivalent of hundreds of full-time roles in support and back-office finance work was being handled by AI systems within about a year. Work that used to require a large standing team, now compressed into a much smaller one supervising the machine. That case became a widely cited data point precisely because it wasn't hypothetical. It was a real company, in a real earnings call, describing a real headcount number. Cases like this don't prove that every accounting job vanishes overnight. They prove something narrower and more important. When a company's entire workflow is digital already, the technical barrier to automating the repetitive parts of finance work has essentially disappeared. The remaining barrier isn't technology. It's how fast an organization is willing to restructure itself around it. This is where the human cost becomes concrete, and it's concentrated in one specific place, the bottom of the career ladder. For generations, the path into accounting ran through entry-level roles, junior positions where new graduates learned the profession by doing exactly the repetitive, high-volume tasks that AI now handles fastest. Reconciling accounts, preparing draft filings for review, processing routine invoices. Those jobs weren't just income for new graduates. They were training. They were how a 22-year-old learned to recognize what a healthy set of books looks like by handling thousands of ordinary ones before they ever had to judge an unusual one. If AI absorbs that layer of work, the profession doesn't just lose a category of jobs. It loses the traditional way people become senior accountants in the first place. Several major accounting and consulting firms have already begun reporting measurably smaller entry-level hiring classes, citing AI-driven efficiency directly. The rung at the bottom of the ladder is the one disappearing first. So, what can't AI do? Because the honest answer isn't nothing, and it isn't everything either. AI is extraordinarily good at pattern matching against precedent. It can tell you how the last 10,000 similar transactions were classified. It's much weaker at genuine judgment calls, where the right answer depends on intent, context, or a regulation so new there's no precedent to match against yet. A business owner asking, "Should I classify this borderline expense as a deduction?" knowing my specific situation and risk tolerance, is asking a question an algorithm can inform, but shouldn't answer a loan. AI also can't take on legal liability. When a filing turns out to be wrong, a licensed accountant is professionally and sometimes legally accountable for that number in a way that a software vendor is not. And AI still struggles badly with genuinely novel situations. A brand new tax law, an unprecedented business structure, a court ruling that changes how a whole category of transactions should be treated. Precedent matching breaks down exactly where judgment is needed most. This pattern isn't new, and history offers a useful, if imperfect, guide. When automated teller machines spread through banking in the 1970s and 80s, the common prediction was that bank tellers would simply disappear. They didn't. Their numbers eventually declined, but far more slowly than the doom predictions suggested, because the job shifted from transaction processing towards sales, service, and advice, the parts machines couldn't do. Travel agents tell a harsher version of the same story. When online booking made the core transactional function of the job nearly free, the profession shrank dramatically, and only a smaller, more specialized version of it, focused on complex, high-value trip planning, survived. Accounting likely sits somewhere between those two outcomes. The routine transactional core is shrinking fast, much like travel booking did. But unlike a vacation itinerary, a company's finances carry legal liability, regulatory complexity, and a genuine need for a trusted human signature. Forces that pull the profession closer to the bank teller's slower, partial decline than the travel agent's collapse. None of this means the accounting profession is shrinking into nothing. It means it's reorganizing around a different center of gravity. As AI absorbs the mechanical layer of the work, new roles are emerging that didn't exist a decade ago. Someone has to design, train, and audit the AI systems doing the classification and detection, a genuinely new specialty sitting at the intersection of accounting and data science. Someone has to interpret the anomalies the AI flags, translating a statistical outlier into a business explanation a regulator or a board will accept. And as routine compliance work shrinks, the advisory side of the profession, helping a business actually plan its financial future, not just report its past, becomes a larger share of what accountants are paid for. The accountants best positioned for this shift aren't the fastest at manual data entry. They're the ones comfortable directing a system that already does that part, and spending their expertise on the judgment calls sitting just above it. One thing that slows this transition down more than most people expect: the law itself. Tax and financial regulation isn't one global standard. It's thousands of overlapping jurisdictions, each writing its own rules, each amending them on its own schedule, often in dense legal language that wasn't written with machine passing in mind. An AI system trained brilliantly on last year's tax code can be caught flat-footed by a single clause changed in this year's budget bill. Multinational companies face this problem multiplied across every country they operate in, each with its own reporting standards, deadlines, and enforcement quirks. This regulatory patchwork acts as a natural brake on full automation, not because the underlying calculations are hard, but because reliably discovering what changed, where, and when requires an infrastructure of legal and regulatory tracking that most AI systems still depend on humans to maintain and verify. The technology curve is fast. The legal curve it has to keep pace with is deliberately, structurally slow. The speed of this transition also depends enormously on the size of the business involved. And that's splitting the profession into two very different tracks. Large accounting firms have the capital to build or license sophisticated AI systems, the transaction volume to make automation worth the investment, and the in-house expertise to audit the AI's own outputs for errors. For them, adoption is accelerating fast, and it shows up directly in headcount decisions. Small accounting practices and independent bookkeepers face a very different reality. They often can't justify the cost of enterprise-grade AI tools for a handful of clients, and their work leans more heavily on personal relationships and local knowledge that generic AI tools don't easily replicate. This creates a real divergence. The segment of the profession serving large, standardized clients is being reshaped the fastest, while the smaller, more relationship-driven end of the market is changing much more slowly. For now, insulated less by superior technology and more by the economics of scale. So, where does the timeline actually land when you strip away both the hype and the reassurance? Multiple industry surveys and professional bodies now estimate that a substantial share of current accounting tasks, often cited in the range of 40 to 60%, could be automated with tools that already exist today, not tools waiting to be invented. That's strikingly different from saying 40 to 60% of accounting jobs disappear, because most roles bundle automatable and non-automatable tasks together in the same job description. A more realistic read of the expert consensus looks like this. The next 5 to 10 years will compress the entry-level and routine compliance layer of the profession significantly, while demand for accountants who can supervise, interpret, and advise holds up far better, and may even grow. The jobs most exposed are the ones defined almost entirely by repetitive processing. The jobs most protected are the ones defined by judgment under uncertainty, client trust, and legal accountability. Which brings us to the actual question sitting underneath all of this. Not, will AI replace accountants? But what is an accountant for once the paperwork does itself? For 6,000 years, the profession's value came from a person's ability to accurately, tediously turn raw activity into trustworthy numbers. That specific skill is now available on demand, instantly, almost for free. What's left is something the profession always had but rarely got to spend enough time on: judgment, trust, and the willingness to put a professional signature and real accountability behind a number that matters. The accountants who treat AI as a threat to outrun are competing in a race they've already structurally lost. The ones who treat it as the most powerful junior staff member they've ever had are the ones likely to still be essential a decade from now. The ledger isn't disappearing. The question is simply who, or what, gets to keep the book.